Hello everyone, welcome to lecture 4 of module 12 in which we are going to deal with the numericals with regards to the discounted cash flow model of valuation of business. As you have already gone through the study about the different assumptions and the different formulations that are going to be used in this model, we are now practically going to solve the question and find out how to compute the value of the business using this particular model, which is one of the most celebrated model of evaluating any business. To start with the question, before dealing with the question, I want to tell you, if you can see the slides, you can have 4 slides divided into different parts of the question. So just go through the question once or more than once so that you can understand what I'm doing and how you can solve the question using the different steps. To start with the question, we have certain information with regards to the financials of a company regarding sale, operating expenses, earning before depreciation, interest and taxes, then depreciation, then EBIT and then the tax rate. Next is given the information regarding the current level of the fixed assets is rupees 40 lakh, corresponding level of net current assets is also given. Sales are expected to grow at the rate of 10% for the next 5 years. During the same time, the operating expenses are expected to increase at a rate of 8%. Depreciation is to be charged at the rate of 10% of the net fixed assets. And you are also given the information regards the investment as an expansion plan. Then we have the information regarding post-tax non-operating cash flows of the company, and then we have to compute the value of the Essence enterprise. So to start with, we start with the step 1. This step 1 is calculation of operating cash flow for the forecast period. As it is mentioned in the question that we are given the corresponding information for the next 5 years, so we are starting with the first column. I'm taking up the particulars or the items to be dealt with, then year 1, year 2, year 3, year 4 and year 5. So as you know, we are going to calculate the operating cash flow. So we first consider the sale. As in the base year, the sale is given 50 lakhs. So we start for the forecasted period. First we take up the item sales. We add up 10% into the sale. So we reach the figure of 55 lakhs in the year 1. Then again we add up 10% of 55 lakhs. We reach the figure of 60 lakh 50,000. Again adding up the 10% of 60 lakh 50,000, we reach the figure of 66 lakh 55,000. Then again adding up the 10%, 73 lakh 20,500. And in the last we reach the figure of 80 lakh 52,550. We are adding up 10% in previous year and calculating the future sales. Similarly, we are taking up the next is the operating expenses. As mentioned in the question is 20 lakhs and the growth in the same is given at the rate of 8% per annum. Similar fashion, we add up 8% of the 20 lakhs. So we reach the figure of 20 lakhs 60,000. Again adding up the 8%, we reach the figure of 23 lakh 32,800. Then 25 lakh 19,424, 27 lakhs 20,980, then 29 lakh 38,660. In sales, we shown the 10% growth. In operating expenses, we shown a growth of 8% as given in the question. So after deducting operating expenses from sale, we got the figure of EBDIT, which is earning before depreciation, interest and taxes. So we got the balancing figure here, 33 lakh 40,000. Then 37 lakh 17,200, 41 lakh 35,576, then 45 lakhs 99,520 rupees, and in the last fifth year 51 lakh 13,890. We haven't taken into account the depreciation yet. So now if we are going to deal with the depreciation, for this we need the computation of depreciation after considering the finance expansion which is given in the question. This is there. The company will make the following investments in the fixed assets. So I am going to go for a working note for the computation of depreciation. Working note. This working note is with regards to the calculation of depreciation. Again, we take up the particulars in column 1, then year 1, year 2, year 3, year 4 and 5. As you can see in the question, the first paragraph has mentioned that the net fixed assets of the company is rupees 40 lakhs. So we take up the net fixed assets at the end of previous year, which was 40 lakh. Then you can see in the next column we move like this. Then we have to see the different additions that we have made at the beginning of the year. I am going to take this 10 lakh rupees. So I'm putting this 10 lakh here. So I got the total of 50 lakhs. As mentioned in the question, that the depreciation is to be charged at the rate of 10% of 50 lakhs would be 5 lakh rupees. So net fixed assets at end of the year would be the balancing figure of 45 lakhs. As you know, it is the end figure, so it will be the figure in the next year. In the opening, 45 lakhs. Then you can see there is no addition in the year 2. So we are having a balancing of 45 lakhs, charging 10% depreciation on the same, 4 lakh 50,000. We got the balance of 40 lakh 50,000, which we take to the third year, 40 lakh 50,000. Addition given is 5 lakh rupees. So we reach the figure of 45 lakh 50,000. Charging 10% depreciation is 4 lakh 55,000. We got the balancing figure of 40 lakh 95,000. Taking to year 4, 40 lakh 95,000. As mentioned in the information that there is an further investment in the fixed assets amounting to rupees 7 lakh 50,000. I reached the figure of 48 lakh 45,000. Charging 10% depreciation would be 4 lakh 84,500. and the balancing figure would be 43,60,500. You can see there are certain changes because of the reason that certain figures I have just rounded off. Then is 43,60,500. There is no addition in the year 5. So our balancing figure would remain the same, 43,60,500. 10% depreciation is 4,36,050 rupees. And the balancing figure is 39,24,450. As we need this depreciation to be taken care of while computing the value of operating cash flow. So we will take this here from the working note. Now my depreciation is 5 lakh for the first year, 4,50,000 for the second year, 4,55,000 for the third year, 4,84,500 for the fourth year, and 4,36,050 rupees for the fifth year. So after deducting it, we reach the figure of EBIT. This is earning before interest and taxes. The balancing figure is 28,40,000, 32,67,200, 36,80,576, 41,15,020, and 46,77,840. Nothing is mentioned in the question about interest, so we move directly to the tax, which is given at the rate of 40%, which we compute on the profit. So it is coming to 11,36,000 for the first year, 13,06,880 for the second year, third year 14,72,230, 16,46,008 rupees, and 18,71,136. Now after dealing with this, we reach the figure of profit after taxes. So the first year we got the PAT is equal to 17,04,000, 19,60,320, 22,08,346, 24,69,012, and the last is 28,06,704. So using this profit after taxes and the depreciation, because now we are in a process to compute the operating cash flow for all the 5 years. Year 1, year 2, year 3, year 4, year 5. For calculating operating cash flow, we are given profit after tax, which we just computed. That was there 17,04,000, 19,60,320, 22,08,346, 24,69,012 rupees, 28,06,704. As we know, we will have to add back the depreciation for all the respective years, which was given. We just computed 5 lakhs, 4,50,000, 4,55,000, then 4,84,500, 4,36,050. So once we add it back, we will reach the figure of net operating cash flow, which comes to 22,04,000, 24 lakh 10,320, 26 lakh 63,346, 29 lakh 53,512, 32 lakh 42,754. This is our step number 1 with the working note. Now moving to next, that is the step 2, calculation of gross investment. So again, we are preparing a table with the 6 columns, particulars, year 1, year 2, year 3, year 4 and 5. So we start with the current assets first. Total net current assets, as it is mentioned in the question, that in the previous year it was 5 lakh, and then we take net current assets at end of previous year, that was 5 lakh rupees. Then this total net current assets is the 10% of the fixed assets of the given year, which is given in the information also. So I'm taking that 10% and then adding up the last year figure. There is no further investment is given. Investment in net current assets, nothing is mentioned for the year 1. So this would be 10 lakh only. So my gross investment would be 10 lakh. Then in the second year, 4 lakh 50,000, adding up the previous year figure of 5 lakh. We are given that there is a investment in the net current assets. This is the change in the two figures. Let me mention here once again to make it clear to you that we are comparing the change. As we can see, there is no investment as such in the current assets in the first year. So we just taken into account the investment in fixed assets, which is gross 10 lakh rupees. So our gross investment would be 10 lakh. And in the second year, you can see there is a decrease of 50,000 in the current assets. So investment would be in negative. Investment in the fixed assets in the new year is given nil. So the gross investment would be negative of 50,000 here. Then going to next year, 4,55,000 to be compared with the past year figure of 4,50,000. We have a positive change of 5,000, and investment in fixed assets is given 5 lakh rupees. So the total outflow will become 5,05,000 in the third year. In the fourth year, the opening is 484,500 comparative to the past year of 4,55,000. We have a positive figure left, 29,500, and further investments made in the fixed assets is 7,50,000. Then we reach the figure of 7,79,500. Year 5, we have 4,36,050, which is to be compared with 4,84,500 of the past year. So it is again a negative figure of 48,450. No investment is made in the fixed assets. So our inflow or the outflow in this, or investment in the Assets would be in the negative term. It is 48,450. Moving to next, step 3. Calculation of free cash flow. Particulars: year 1, year 2, year 3, year 4 and year 5. Opening cash flow. Just computed 22 lakh 4,000. For the second year, it is 24 lakh 10,320. Third year, 26 lakh 63,346. 29 lakh 53,512 for fourth year, and for the fifth year it is 32 lakh 42,754. Now we compare it with our gross investment less gross investment. We just computed in the step 2, which shows whether it is our outflow or inflow, whatever, as per the balancing figure left. So in the first year we have an outflow of 10 lakh. Second year we have 50,000 showing an inflow, then 5 lakh 5,000 outflow, 7 lakh 79,500 outflow, 48,450 means inflow. Treating it, we got a figure of 12 lakh 4,000. Here we have 24 lakh 60,320, 21 lakh 58,346, 21 lakh 74,012, 32 lakh 91,204 for the fifth year. Then we have non-operating. This figure is our free cash flow from operation. Then we take up non-operating cash flows, 5 lakh, which is given in the question. There is no such cash flow in the second year. Then it is 2,50,000 in the third year. Then it is 10 lakh in the year 4, and there is no non-operating cash flow in the fifth year. So we are here to reach the figure of exact free cash flow, which is 12 plus 5, 17 lakh 4,000, 24 lakh 60,320, 24 lakh 8,346, 31 lakh 74,012, 32 lakhs 91,204. So this is our step number 3. Moving ahead to the step number 4, now we are there to calculate the cost of capital. As you know, we are going to calculate the weighted average cost of capital. So what is given in the question, we just use the cost of capital. I'm just mentioning the rate which is given in the question. 8% per annum is the cost given. So 0.08% I have taken of the total capital we are utilizing as per the weights. then 0.15 for the debt, which we used as a 55 out of the total 75 of the capitalization of the company. So we reached a figure of 0.021 plus 0.11, which falls to 0.131. As we have to compute it, the cost in the percentage, so we multiply it with 100 and we reach the figure of 13.1%. Moving to next, step number 5, where we are supposed to calculate the present value of free cash flow, which we just computed in the step number 3. Now I'm taking year, then free cash flow as we calculated, then the PV factor. As you can see, the cost of capital is 13.1%, so we assumed here the PV factor 13%. Then we calculate the present value. Taking up all the 5 years. As we just computed, for the first year it is 17,04,000. Second year 24,60,320. 24,08,346. 31,74,012. 32,91,204. You can consult the PV factor table given in the different financial accounting books. You can find the value of 0.885 for the first year, 0.783 for the second year, 0.693 for the third year, 0.613 for the fourth year, and 0.543 for the fifth year. Now we multiply the free cash flow with the PV factor. So we got the figure of 15,08,040 rupees, 19,26,430, 16,61,759, 19,45,670, and the last is 17,87,124. Now we compute the total of the present value of the free cash flows. Total would be rupees 88,29,023. Now the step 6 is the calculation of discounted continuing value. For that we have a formula of free cash flow into 1 plus the growth rate to be divided by cost of capital This is our step 6. So we reached the figure of 32,91,204, which was our free cash flow of the last year, that is the 5th year. Here it is 32,91,204 to be multiplied (1 plus 10% of the growth rate) to be divided by the cost of capital. We just computed 13.1% and the growth rate is 10%. So while we solve this, we reached the figure of 11 crore 67,84,645. Now we calculate the value of company. For that, we use the formula of value of company would be equal to discounted free cash flows plus discounted continuing value. This was we just computed 88,29,023 to be added to the figure of 11 crores 67,84,645. So reach the figure of 12 crores 56,13,668. That's all from my side. I hope now you will be able to calculate the value of the firm using DCF model, one of the most used model for the valuation of any business. Thank you so much for your kind attention. Thank you.